30% to NS Capital, which these are really the absolute return managers.
Hi everyone, I'm Michel Girardin, a member of the Portfolio Advisory Board here at Novastone Capital in Geneva. We just had our meeting to discuss what we do in our investment portfolio. And we did that together with BCA and PIMCO, and obviously Christian Malek, the CEO of Novastone Capital, and Riccardo Cataghiri, the Chief Investment Officer. So in our last meeting, we highlighted two major risks, macroeconomic risks, in the US and in China. We thought that maybe there was a risk that the US would enter into a recession and China would experience a hard landing. We excluded both risks, but we did mention that they were to be monitored. And indeed, what we experienced right a few weeks after our meeting is that markets became very fearful of both risks, and we experienced a lot of volatility, mainly because of China, but also on fears that the US economy could actually be much weaker than expected and possibly go into recessions. But in the end, these two fears abated, and I'll show you some graphs in this respect. Well, actually, in this first graph you see here, I depict here the evolution of the US oil prices. The bars, which indicate recessions, typically are preceded by an increase in oil prices by 20% or more. There's a lot of debate on whether US oil prices, whether their fall is a positive or a negative for the economy in the US and globally. But all in all, I would say that it's, and as you can see from this chart, that it's more an increase in the oil prices by 20% or more, which has been followed by a recession. It's certainly not a drop by 50%. 50%, that's a staggering number of these oil prices in real term, i.e. after inflation. A decrease by that magnitude cannot possibly be associated with a recession. If there is one risk that we monitor very closely in the US, it's the risk of inflation. Actually, as you can see from this chart here, what we put here together is these two curves. One is the difference between the unemployment rate and the so-called NAIRU. The NAIRU, non-accelerating inflation rate of unemployment, is, if you prefer, the unemployment rate which corresponds to full employment. So the difference between the two gives you the slag in the job market. And we can see that the slag is 0 here officially. We are at full employment. And hence, we should probably, if there's a risk we monitor, and we do monitor very closely, the possibility that we get some wage pressure. You can see from the line here that wages are currently rising at slightly above 2%, but the NAIRU gap, which is closed now to the unemployment rate, suggests that they should probably increase by more than 3%. Indeed, the Federal Reserve in Atlanta is closely monitoring that and is suggesting that possibly we could have a deferred impact on wages which could trigger some cost push inflation. So that's a risk we monitor. Moving to the Eurozone, we feel confident that at some point the policy of the ECB, the European Central Bank, will prove positive for the economy. And we have some evidence that it is starting, albeit slowly, to prove positive. Indeed, if you can see from this chart, we see that the balance sheet of the ECB still has been expanding, but remains far below that of the Federal Reserve and also of the Swiss National Bank and the Bank of Japan. So the ECB, Mario Draghi, still has room for expansion, and he did promise that if need be, he will come up with new stimulus, a fresh monetary stimulus to kickstart the economy. Moving to Japan, we've been a bit disappointed, and as you can see, you will see from our conclusions, we downgraded our view on Japanese equities from overweight to neutral. on grounds that the economy proves a bit disappointing. So the jury is still out on deciding whether the economy will make its way out of the deflation period. If there was one major risk pending during this first quarter, it's the risk that the China landing would not be soft but hard. So indeed a lot of fear by investors that a so-called hard landing in China. Well, you see from this chart that this fear has been abating quite sharply. It's a chart that shows you how many times, how many Google search there are with the terms China hard landing. And you see that this fear has been abating. And now we have some evidence that the Chinese economy is bottoming out. And indeed, we have also fresh promises from the central bank, the People's Bank of China, that if need be, like the ECB, they will come with new measures to kickstart the economy. All in all, and this is the last chart of this presentation, we see that the global macroeconomic picture remains positive, but we insist here over the long term for risky assets and for equities. And we see that by putting together these two charts, these two lines on the chart. One depicts world GDP, it's in green, and you see it's rising still at sort of 3.3%. And we're only seeing a mild slowdown going in 2017 to roughly 3%. And the other line in red shows the performance gap between equities and bonds. So it's the performance of the MSCI World Index for equities and a government bond index also year on year. And you see that this gap is negative. So what we see from this chart, the main conclusion is that you should be positioned in equities when there's an upswing in the economy, and you should be going for bonds when you have an economic slowdown. So if there is a gap like now between growth, which is still positive, and the fact that equities have been underperforming bonds by something like 10%, then it means that there is a gap which is positive there for equities. So the global macroeconomic picture remains supportive for risky assets. This is our main conclusion. But in the short term, we are cautious about equities. We highlight this by the three exits risks. As you know, in June 23rd, there will be the Brexit referendum in the UK. This could prove very volatile for equity markets. So this is the first exit risk. Then we do not exclude that Greece comes back onto the scene and under the limelights. And we talk about here again about a Grexit risk. And last but not least, there's the risk that central bank reverse their injections of liquidity. So we talk about here exits of central banks, liquidity injections. For the time being, this risk is low, but it's still to be monitored. So all in all, our position is that we remain cautious in the short term, and in particular, we underweight the US equities, a bucket. We remain positive on the Eurozone, so we overweight Eurozone equities. We've moved Japanese equities from positive to neutral. Moving to emerging markets, we remain underweight, although we keep a positive stance on the Asia-Pacific region within the emerging market bucket. Moving to fixed income, we believe that there will be opportunities to invest there, mainly thanks to central bank policies which remain expansionary. But for the time being, we are somewhat cautious and on the sidelines. On moving to credit spreads, we saw that they've been widening, and this provides opportunities. But for the time being, we are neutral. We keep a neutral position here. All in all, we favor in our asset allocations those dynamic managers which have flexibility in allocating between different asset classes. This is what you need going forward within these difficult markets. It's this flexibility to shift swiftly from cash, bonds to equities, so work in an absolute return setting. Well, that's all for me now. I wish you a very nice summer, and see you again after the summer. Oh, by the way, if you have any comments or questions, please, I'll be very happy to answer that. You can send an email. The address shows on the screen. It's info@novastonecapital.com. Thank you. Bye-bye.